Welcome here, friends. This is session number 2 in the video series teaching you how to use stock options to create a full-time income in less time per day than it takes for you to drive to and from work. My name is Andrew Ferguson. I run a company called Trading Options Daily, where my main mission is to teach 10,000 investors just like yourselves how to invest with stock options in 30 minutes a day from your phone so you can live your dream life. I want you to succeed more than anything in the world, which is why I'm giving away my entire system here for free in these videos. So let's get into session number 2. We're talking about my stock hacking strategy. Session number 2, my stock hacking strategy. We're getting into the good stuff now. Damn, you guys are lucky. I wish I could have gotten this for free back when I learned it. That's okay. I put in my time, put in the effort, giving it away to you for free here. So the first lesson here today, the strategy of how I sell naked puts, how they work, how you use your phone in 30 minutes a day to invest in the stock market. And because we want to keep our time investment low here, we have to focus on one strategy only. It's kind of like if you're at the bar and you're trying to pick up, you can go after like every single one that passes you by. But if you lock into one target, do a little bit of research, maybe ask your friends about them, you flirt a bit, get them talking, and boom, done deal, close it off, go enjoy the fun stuff. And lastly, today we want to be talking about the odds and turning the best odds of profit in each trade we make. So we learn how to find that profits percentage. And it's a part of our ability to assess risk. And it's kind of like if you've been to the grocery store and you're picking up like a fruit, looking up an apple, you kind of squeeze it, look it over, think about if you want to eat it or not, and if it's going to last as long as you need it to. That's kind of the risk assessment you do in real life. We're just going to take that one step further and apply it to the stock market here in session number 2. If you guys missed session number 1, check out the end card there to go back and check it out. Make sure you have the good vocabulary and terminology that we're getting into and use today in this session. So right now, I have the power of selling put options and knowing old 90s or maybe even 80s cartoons like He-Man, Masters of the Universe. But I really wanted to show you and give you ultimately the power that you can use this and do it yourself as well. That's my main goal here. So we're talking about selling naked puts. We're talking about the mobile money formula. Better than real estate for cash flow, less volatile than cryptocurrencies. You're in control. You answer to no one like in a business. We're going to convert your phone into a money printing machine by selling out of the money naked put contracts. We covered out of the money in session number 1. Again, go back and review that if you are out of date with what that means. Mobile means mobile. That means you could do this lying on the beach in Dominican, assuming that they have Wi-Fi there, which they do because I've been there. The 2 most remote places that I've been, though, was trading on an actual ferry crossing the Bay of Fundy in Atlantic Canada and in a beach in Mexico. Around the same time, the Raptors were kind of battling the Milwaukee Bucks in the Eastern Conference Finals on the way to the NBA title. Shout out to the Raps, Fred VanVleet, Pascal. But yeah, literally anywhere you want to go, as long as you have your phone, you can earn dollars with this strategy. You want to do this. You target companies that you want to own anyway. You get paid cash to buy stocks that we want. And you can use this cash then to get a discount if we end up actually having to buy shares of the stocks that we're targeting. That's how it works, very high level. We're breaking it down. Same starting point at the top. We sell naked put contract. Let's go down the left side here first and see what that looks like. So the majority of the time, that's what we want to have happen. Not that the right side is any worse or it's bad, but it's going to end up there sometimes. But we can make money faster, make more of it if we stay on the left-handed side of the path. So the first path, sell a naked put contract in your interactive brokers or your mobile app on your phone. You get paid premium. Remember, we talked about this last session. You get paid premium as a seller to take on risk. And if the stock price stays the same or goes up, you keep the premium and you just repeat when the contract expires. That's what you want to see have happen. And when you do that and the stock moves up and you sell your naked put, you make money very, very quickly, which is great. But Andrew, what happens if it doesn't go up and it goes down? Well, we go to the right side of the chart then. We still sell a naked put contract. We still get paid premium. We keep that premium no matter what, which is a nice spot here. If the stock price goes down, we keep the premium again, and we have to buy 100 shares of our stock. Remember the rule of 100 from last session, 100 shares at our strike price. And then we have 2 options from there. We can either hold the shares and wait for the stock price to go back up and appreciate, or we can hold the shares and sell what's known as covered calls to earn even more premium. And then when you do that with naked puts and covered calls, that's called the wheel strategy. So those are the 2 options there for what we can do if we get assigned shares. Now, if you can get this and you understand this stuff, you can use it forever. This can work for you. It is yours. You just have to put in the time and the experience will come. You cannot lose experience. It just cannot be taken from you. If you lose a little bit of money, that's okay. If you get the experience down, you can use it forever. This is what I'm talking about. Let's look at an example now with an insurance contract, because essentially what we're doing here, When we sell naked puts, we are selling insurance. We sell contracts and have to pay if something happened. So a young couple are going traveling on their honeymoon, and before they leave, you get them to agree to a 1-month contract for insurance to go on a Bali. You're gonna have a great time, have a fantastic trip. You're gonna get paid to sell them that contract, and they're gonna pay you $500. And if something was to happen on their trip, you have to pay them $25,000. That's the coverage they bought into. But all is good after 3 weeks. The couple, you offer them a contract cancellation policy. Since there's only 1 week left, and they say, oh, you know what, I'll give you back $50 of that $500 you got paid. And then they say, oh, you know what? Yeah, I'll take $50 back. We'll cancel the insurance. Things have been going really, really well. It's unlikely for something bad to happen. And then you're no longer on the hook to pay the $25,000. They get an extra $50 to tip their barista or whatever at the bar. Everything's good. You, as the option seller or the insurance seller in this case, you have to keep $450, right? Are you guys getting this? Does this make sense? You sold them a contract. You got paid to do that. And you potentially had to pay out 25 G's if something happened to that couple. But because you didn't, you got to keep most of the cash and then go ahead and you can sell that new contract to somebody else going on their honeymoon. Are you guys with me on this? Making sense? Okay, we're doing the same thing when we sell naked put contracts. We sell out of the money contracts, OTMs, and the strike price is going to tell us how much money we have to set aside to potentially buy shares. Or in the insurance example, it was to pay the young couple in case something bad happened, right? So we get paid $332 in premium in this example here. It's highlighted in red. It's the middle between the bid and ask. Then you just times that number by 100, again, rule of 100. And we target a month-long expiration date. Expiration date here in the middle, February 18th, 28 days. So it'll expire in 28 days later. Also a great zombie movie for those fans out there. If you guys are getting this, great. If not, throw a comment in the chat right now. I'll pick it up and make sure I answer it for you so you make sure this stuff sinks in. Sound good? Okay. The order screen in the Interactive Brokers app or other apps that you can use, it's going to look something like this. The top left is the sell order. You can change it to blue if you want to buy something, but you want to always be selling with this strategy. Selling, selling, selling naked puts. Delta also pops up, which is one of the Greeks we're going to get into. And Delta right there is telling you your percentage of being assigned shares at this moment in time. This number right here, you make that a percentage, just put a little percentage behind it, 28.7% chance of being assigned shares. This is one of the most important screens when you're doing options trading, no matter what kind of app you're using. This is where you input all the data in order to send in an order. So we don't want to mess this up. When you're starting out as an options trader and you're selling put options, you want to have a quantity of one. Start small. Maybe you want to paper trade it for a bit and just get your kind of feet underneath you. If you want to open up a paper trading account, check out this card right here. You can do that. It'll show you how to do that, walk you through it. But you want the order type to be a limit. We always lose limit because that locks us in like a fair price that we're not going to get screwed on. And we also use the mid. Okay, time in force is day. And we always use day. We don't want to be good till canceled because then it opens it up till multiple days and the market can move against us. So we always want to use day. Once those are in there, and it's always good practice in the Interactive Brokers, you can do this. You can click that little calculator button in the bottom right. It'll pop up with these kind of balances for your account. And you want to make sure your account's going up in value because you are getting paid as an option seller. You're being paid that premium. It should always be positive. Make sure your actual account value is increasing. And then you know that you're selling and getting paid. You swipe right to submit. And just like Tinder, right? Confirm your interest. I mean order, and you're good to go. That's as easy as it goes. So when you're doing this, you can calculate your returns on your capital that you're using. Everybody wants to get a good return. You want to have 10, 20, 30% we talked about in session 1, but the amount of money that you earned divided by the amount of money that you use to get it is your return on capital. So in this example, we would get paid $332 in premium. We'd have $15,500 is a strike price. That's the money we'd have to be on the hook for, potentially pay out. Think about our insurance example, right? That's the insurance value of the contract. If you divide 332 by 15.5, you get 2.14%. But you say, Andrew, that's not a great return. Like you promised me 20, 30% returns. Well, give me a second here, okay? If we annualize that return, which just means if you just take that same number, and since we did it over the course of a month, theoretically, we can do it 12 more times that year, or even 13 because it's only 28 days. So you take that, and then you take that 2.14%, right? And we take it, and we annualize it over the course of the full year. You can do it 13 times. It ends up being a 27.9% annualized return. So pretty close to 30% a year on your own. Okay. The rest of this presentation is it's just all filler, right? You got this, right? No, I'm just kidding. The rest is all very important. So keep checking in here. Swiping right is the easy way to do this at the end, but knowing which company to pick, setting your strike price, all the other stuff is what makes this strategy really work. On to lesson number 2. We want to become a master of one and a jack of none with this, because boring is always best in the stock market. We do not want to have to overthink this. We want to have a repeatable process for consistent returns, like our boy Ryan Reynolds in The Hitman's Bodyguard. If you've seen the movie, you know he's a bodyguard who protects super important clients. And the beginning of the movie shows him acting all professional, under the radar, and his motto is boring is always best. Samuel L. Jackson is the hitman. It does everything opposite of that. Again, great flick, but the takeaway here is boring is best, boring and repeatable. There are literally hundreds of different ways you could trade in the stock market and invest. Day trading, swing trading, you see the list there. Like, it goes on and on and on. This is just a quick list off the top of my head. So in order to whittle down your options, no pun intended, we need to increase your odds of success, right? We're going back to picking up someone at the bar. Put it in time with that one person and only that one person, and you have a likelihood of better success. So become a master of one and a jack of none. And that just goes for whatever you're going to invest in. If you want to do options, you want to do day trading, whatever you want to do, become a master of that one thing and you'll be better off for it. So I'm going to ask you here now, what's your biggest asset? Because when we do that, we focus on one strategy. We were protecting your time, which in my opinion is your biggest asset. You only have so much time in the world. We want to protect it. We want to get you in, get you out 30 minutes a day, right? The commuting thing, to from work, 30 minutes a day is all you want to have to put into this, and get back what's most important to you, your time. We also want to do a master of one strategy to limit risk. We want to be able to pick good companies that we know. We want to be able to do the same thing on all these companies and feel confident in this. And by doing that, we limit mistakes, we limit the bad stuff, limit the risk. It's not completely gone, but it's limited. When we're doing this strategy with selling naked puts, we are looking for a 1% return on every trade that we make, which means that the premium that we're paid should be 1% of the strike price. So if the strike price is $1.50, we should be looking for premium of $1.50, because remember, the rule of 100, you're going to multiply that by 100. 1.5 times 100 is 150, so it equals out to 1%. That's our goal for every trade that we make. And the more consistent and disciplined your approach, the quicker you're going to learn this stuff, which works best for you, and the quicker you're going to progress from small goals to big goals to just crazy stuff you can't even fathom yet. Like, I went from paying a few bills each month with options to options replacing a good chunk of my income as a project manager. So my ultimate life goal is creating freedom for myself and my wife. And I know we're on the right path. We just have to put in the reps to get there. Lesson number 3 for this. All right, we're starting in on the Greeks. Are you not entertained? Yeah, that was Gladiators. So that was just about Rome. I just couldn't think of any kind of quote where that was kind of close. So if you have suggestions, leave a comment again for different quotes I could use next time. But you want to figure out your odds of winning before you make a trade. If you can do that, you become more successful. So we talked about Delta a little bit already, but it is the odds of being assigned shares at any given point. When we enter a trade, it's at that time, those are our odds, okay? Because Delta does move a little bit. It's also on secondary kind of feature. It tells us the rate of change of an options contract for every dollar change in the underlying stock price. Now, if that's a lot for you, remember, just take it easy, rewatch this. You'll get it if you just let it sink in. But starting with Delta as that target for percentage win, okay? We want to use Delta to check our assigned percentage of getting shares. As a beginner, you probably want to go low Delta, 15, 25%. So here, out of this list here, if we're looking at these lists in red, the 155 would be acceptable. It's under 25%. The 150 would be acceptable, but we don't want to go any lower than that because we want to make sure we hit our 1% rule, right? 1% rule, 155. This got to be 1.55 in here. This one's just below 1.5 here, but maybe we'll make it work, low Delta. So we combine those two things and we look for trades to make. That's kind of our guiding principles here to kind of keep us on the right path, keep us on the left side of this column where we want to keep a 75% win rate and only 25% of the time go to this side on the right. We want to keep it over here in the green and we'll be good. But sometimes it's going to go to the right, not just the reality of the stock market. But if 75% of the time we give ourselves a chance to stay left, That's a pretty good batting average. MLB wise, 75% of the TAM is good. So focus on that 15 to 25% delta, but keep that 1% rule in mind. So the 155 strike is the one in this options here. It has a contract value of 217, which means it's above 1%, which is great for our returns and also gives us a low amount of risk going into this trade. Now, the other thing that delta does, it is a rate of change. So this one's a little bit more math driven. So stay with me here on this one. I'll go through it slow. The underlying price for Apple is the stock price for the stock. Your delta is at 21% or 0.21. If the option contract we just talked about has a value of 2.17, right? If Apple's share price moves up by $1 to 168.73, the value of that 217 is going to change. The value of the put option is going to change. And this is what's going to happen. If the stock price goes up by $1, the value of the put option is going to go down by the delta. Okay. So that delta is 21%. The stock price itself goes up $1. The delta is going to go down. Okay. The premium is going to go down and you're going to change from 2.17 down to 1.96. So think of it this way. As the stock price goes up, delta is going to change the contract value of the put and it's going to make it a little bit less money. Now, if the stock price goes down, delta is going to do the opposite. It's going to actually increase the value of the put option or make it more likely for you to get assigned by a little bit. So if you're going to get more likely to get assigned, you're going to get paid a little bit more. So if the value goes down by $1 of the stock, the delta is going to bring it up, the contract value, and it's going to look like this. Stock price down, value of the put goes up, you get paid a little bit more, okay? And it's good, but you take on a little bit more risk. So why does it move like this? Well, basically when a stock price goes down, it's now more likely that you're going to be assigned shares because the strike price that you chose or are choosing is now closer to the actual stock price. And when it goes up, it's further away, so it's less likely, so you get paid less as an investor. So if someone else there were to sell the same put, they would need to be paid more for taking on additional risk, or they're going to be paid less for taking on less risk. It's just a risk kind of adjustment in the price of the contract. What we want to do though, is we want to sell the put. We want the stock price to move up, which then decreases the value of that put that we sold. And if it decreases quickly, we can make more money by doing this one thing. And it's called rotating our capital. So remember, at any given time, delta is going to tell you your likelihood of being assigned shares. It's also going to fluctuate. And when there's only like 1 or 2 days left on an expiry and the underlying stock price is below your strike price, delta is going to be 99%. Like in other words, you're going to almost guarantee you're going to have to buy those shares. So just check your deltas before you make a trade. It's fluid, it fluctuates, but at that time, it gives you the winning percentage and the percentage that the contract is going to change. So make sure you check delta on every trade. Now, we've just gone through the basics of my options trading strategy. In part 3 of this video series, you're going to see the next half of my strategy. Continue to get the full view. Make sure you check out the next video. Make sure you subscribe to the channel, like this video, keep checking in. New ones coming out very, very soon. We're going to keep progressing through this all for free, all for you guys to make a solid income, 30 minutes a day from your smartphone in less time than it took you to commute to work today. So check out the next video right here.